Hey, Dad, I'm so glad you asked me about the market because I just got this software today and I've been eager to test it out. So, let me tell you a little bit about the market right now and, you know, where uh, today's move fits in the overall context of the market. So, this is today's move right here. It's a very strong move. It was a 33 point move in the S&P 500, which is a rare move. Usually, the average daily range for a move in the S&P 500 might be somewhere between 7 and 15 points. So a 33 point move is pretty strong. This is on the back of some of the announcements that came out of Europe in terms of, adding increased liquidity for their banks and coming up with a centralized banking authority over banks across the European Union, which is all good news. A lot of this stuff may not come online for a couple of months at least, so it bears noting that although the news is good, the material impact of these announcements have yet to be really truly seen or enacted. Um, um, and so, we're still in wait and see mode. Okay, so the level that we have to take out is right here. This day, 6/19/2012, there was a high of 1363.46. Okay, so even though we had a very strong 33 point move, we did not take out, this level here, which is sort of the base case for a continued uptrend. This base condition, has to be satisfied. So, we'll see on Monday, whether or not we get any follow through to the move that we had today. The one, constructive thing that you can say about the market here is that it's holding above this red line, which is the 200-day moving average, and it has recently crossed back above this blue line, which is the 50-day moving average. So your 200-day is your longer term investment sentiment, and that held, on June 4th, which is a positive event for this market. And right now it's sort of holding in this range, sort of in the neighborhood of the 50-day moving average, which is positive. So is it possible that the correction is over? Maybe. Is it possible that there's more downside? Also maybe. So it's really too soon to tell right now. But if we can clear this 1363.50, 1363.46 to be exact, we will most likely test the top end of this range. And if we'll see what happens when we get there. And it's really about evidence. It's about the market proving to you, what it's going to do. Not really making predictions, but reacting as the market proves that it has the capability of either going higher or going lower. So, this little zone that we're in right here, it's still, it's this is a sideline market. It really has been since we got to the 200-day moving average back on June 4th. And now we're just waiting to see, what is going to occur. And, it's no rush to jump in, no rush to make a judgment, no rush to predict whether or not, Europe's going to slow down or China's going to slow down, the United States is going to slow down. We just wait for the chart to develop, and either it's going to break up, up and out above this range here, or it's not. Okay, and we just wait to see how the chart sets up if and when it gets here. Okay, so if it gets above here, we can trade that. If it gets below here, we can trade this too. Okay, but in between, there's really just not a whole lot of reason to just jump in and and jump in whole hog, trying to make some money. Because really, as you can see from this action here, this has been very choppy, back and forth, no real clear direction, no real sense of whether or not the Bulls or Bears have won. And that's really what really characterizes trade between the two moving averages. Oftentimes, I mean, and you go back to the 1890s, to the 1920s, to the 1950s, 1980s, 2000s, and so on. Whenever the price is between, your 50-day moving average and your 200-day moving average, it's generally going to be the choppiest, type of trading. You really want to wait for price to exit in either direction, to either, make money long or short. So anyway, long story short, we're still on the sidelines here, and we're waiting for the market to prove itself. So, good talking to you.